Welcome to the Retirement Planning Show, your source for financial strategies to help you retire with confidence. Featuring Chip Coughlin of Retirement Income Analysts in Syracuse, New York. Chip is a registered representative, and securities are offered through LPL Financial, member of FINRA SIPC. Investment advice offered through Stratus Wealth Partners Ltd. Retirement Income Analysts and Stratus Wealth Partners are separate entities from LPL Financial. And now, here are your co-hosts, Matt Halloran and Chip Coughlin.
Well, welcome to the show. Today, we are going to talk about the 11 strategies to save money on taxes with Chip Coughlin. So, Chip, let's talk about this from a 30,000-foot view at the beginning. Really, what are the things that you need to pay attention before you implement any sort of strategy?
Well, before you implement a strategy like this to reduce your tax liability, you have to make sure that it complements your overall financial plan. It's often advisable to examine your tax situation 2 years at a time. And the goal is to reduce your tax liability over both of those years. But we don't want to have 2 steps forward and 1 step back. We want it to be 3 steps forward. So again, it takes a little bit of planning, but a little bit of planning goes a long way here. Because let's face it, the more money you can keep in your pocket, the less you pay in taxes, the better off it is for you.
Oh, man, brother, I absolutely agree with you on that. So let's walk through number 1, which is participate in your employer-sponsored plan. What does that mean?
Well, that's real important. If your employer has a retirement plan, get into it because it's a great way to save on a monthly or a weekly, however you get paid basis. And I tell my daughters, get in, stay in, and reinvest along the way. Start when you're young because, and I'll repeat this many times today probably, but we tell our clients where you invest and when you invest makes a big difference. Where you want to have a good mix of funds, but when is as young as possible. So get in the employer retirement plan. And I tell my kids where to start. I tell them the maximum minimum. That is the minimum you have to put in to get the maximum match from the company, if they offer that. So you're putting your own money in, you're getting as much of their money as possible. Some plans have a 3 or a 4% match. And if you have to put in 5 to get 4, put in the 5. Because over time, what a difference that's going to make. So if your employer doesn't have a retirement plan, use an IRA or something like that. But start while you're young, start putting the money away, have a savings behavior, make it part of what you do, and build it into your budget, and that'll really pay off downstream.
Well, you just hinted at number 2, which is contribute to a traditional IRA. So if you don't mind, give us a brief difference between the two and why you would choose one over the other.
Okay, well, a 401k is an employer-sponsored plan where the money is withheld from your pay on a per payroll basis. That could be monthly, weekly, biweekly, whatever. The money goes in, you pick how it gets invested in terms of the risk. Do you want to take a lot of risk, a little risk? I think you should diversify, and the risk should be prudent based on your time horizon. But if they don't have a retirement plan at your office, and there's no rule that says an employer has to have a retirement plan, but if they don't, you should have a traditional IRA. And depending on your income, you may be able to deduct that contribution to the IRA. And let me tell you, for an IRA, if you're single, you have to have an income below $62,000 a year because there's a phase out of the deduction between $62,000 and $72,000 in adjusted gross income. But if you're married and you're filing a joint return, the limits are a little higher, $99,000 on up to $119,000 of AGI. So the IRA, like the 401k, provides tax-deferred growth on the monies, but you can put a lot more into your 401k than you can an IRA. Because with an IRA, if you're under 50, this year you can put in $5,500. If you're over 50, there's a catch-up provision, which is an additional $1,000. So over age 50, you can put in $6,500. Compare and contrast that to the 401k. The 401k, you can put in $18,000 a year. And And if you're over 50 years old, there's a catch-up provision there that is an extra $6,000. So if you're over age 50, you can put in as much as $24,000 a year into the 401k. So the limits on the 401k are a little bit higher, but you have to do something. And I say this often, begin with the end in mind. The beginning of your career, I know retirement's a long way off, but a little money over a long period of time gives you an explosion of value. So as Einstein said, the strongest force in nature is compound interest. Let compound interest work for you over time.
Gotcha. So that was number 2. Number 3 is contributing to a flexible spending account. What does that have to do with taxes and saving money on taxes?
Well, let me give you some real-world examples there. Flexible spending accounts are a way to set aside money on a pre-tax basis. Pre-tax, it hasn't been taxed yet, and you can use that for certain types of things. Like in my case, for my children's braces. So we put away money in a flexible spending account. It was pre-tax. We took it out to pay for the orthodontia expenses. So it's a great way. It reduces your taxable income because it's pre-tax. Some of the accounts, if you don't use it up during the year, you lose it. Okay. The monies would be forfeited if you don't use them up during the year. So again, it requires a little bit of planning. Okay, my child's going to have braces. It's going to be this much. I'm going to put X number of dollars away per pay period to fund that, and not much more than that. So you got to be aware of what's coming so that you can put those dollars into the plan. And it could be child care expenses. It could be dental expenses. There's a number of things you can use those for.
All right. So that makes a lot of sense. I love the fact that you have the opportunity to pay. I mean, healthcare can be flipping expensive, man. But number 4, this is the one where you keep talking about taking the long view, Chip. So let's talk about number 4, that you should consider your tax implications before you actually retire.
This is so very important, and many people miss this, but people often receive their largest paychecks upon retirement. And that is because many times they capitalize, the company does, their unused vacation time and their unused sick time, and they add that to their final paycheck. So their last paycheck of the year might be the biggest paycheck they get for the whole year. And we tell our clients, hey, when do you want to retire? We ask them the question, and many of them, because we look at the end of the year as the end of that year, and the next day as a new beginning, and retirement is a new beginning. Many of our clients get their largest paycheck the last paycheck of the year. And what that does is it pushes their income up, so it has the potential to push them into a higher tax bracket. So many times we ask them to wait to receive their final paycheck into the next year, okay, at the end of the first quarter, let's say, so that it doesn't push their income up. And in fact, their taxable income could be significantly less that year. And if they're going to turn on their 401k or their IRAs or their 403b, you haven't had a huge income thus far, and that could work to their benefit. So I would tell everyone, just be mindful of the day you pick for your retirement. And many times the last day of the year is not the best time because they would capitalize perhaps your sick time, vacation time, bonuses, and things like that.
When you're talking about doing the taxes, though, there are some considerations that you need. So you're talking about tax planning there, but when you're actually doing your taxes, there's a couple of considerations that you really need to have here, and that's number 5 and number 6.
Yeah, number 5 is itemized tax deductions, and everybody wants to do that because it allows them to put more on their return. Let me give you some examples. Mortgage interest and points, property taxes, state and local income taxes or sales taxes, medical and dental expenses above a certain percentage of your adjusted gross income, charitable contributions, losses from casualty or theft. These would be uninsured casualty losses, and miscellaneous itemized deductions, which include unreimbursed employee expenses, tax preparation fees. When combined, if they exceed 2% of your adjusted gross income, you get to itemize those. And you really got to be smart to make sure you can itemize those expenses because they can add up over time.
Well, so how do you, so that was number 5, itemize your tax. What is number 6? Because that has to do with number 5, doesn't it?
Well, that's exactly it. If you don't have sufficient deductions to itemize each year, consider how you spend money on deductible expenses. And if you made slight modifications, that may allow you to save by itemizing one year and then the next taking the standard deduction. And like having any non-essential dental or medical work performed in the same calendar year, that might be something you want to consider. Make your charitable contributions in the same calendar year. Group your charitable contributions to give you a larger deduction in the year where you're going to itemize. You could give next year's contribution at the end of this calendar year, if you don't think you'll have enough to itemize the following year. Consider donating appreciated long-term securities to get their full fair market value deduction and pay no tax on the capital gains. So you really have to plan and look at where you are and the amount of deductions you may have and decide, can I itemize my deductions this year and next year perhaps take just the standard deduction because I won't have enough. And you can also, let me just give a couple other things.
Sure.
You could prepay your estimated state income tax balance that would be due by April 15th instead of waiting till that April, okay? You could prepay the second installment of your property taxes and things like that to get ahead of the game and do that in the year where you're going to have itemized deductions versus, spreading them out equally throughout every year. So we just want to plan, we want to be smart, and we want to use the tax laws to stay ahead of the game.
What are adjustments and tax credits, and how do they apply? Because that's number 7.
Okay, we want our clients, if available, to use adjustments and tax credits that can make a big difference in their tax calculation. The adjustments include alimony paid, moving expenses, student loan interest, eligible contributions to a traditional IRA. How about the American Opportunity Credit that provides an annual tax credit up to $2,500 per student, or the Lifetime Learning Credit that offers a tax credit of 20% of qualified educational expenses up to $10,000. So tax credits may be available for expenses such as child and dependent care expenses, adoption expenses, foreign taxes paid, and educational expenses. So you have to do some research. If you're working with a tax professional, they can help you with those. But we don't want anything to fall by the wayside that could help you. Again, paying less in taxes and having more in your pocket is where we want to be.
Okay, so that was number 7, so we're going to go ahead and do a quick recap here. These are the 11 strategies to save money on taxes. Number 1 is participate in your employer-sponsored plan. Number 2 is contribute to a traditional IRA. 3, contribute to a flexible spending account or an FSA. Number 4, consider your tax implications before you retire. 5, itemize tax deductions. 6, consolidate deductible expenses. Number 7, which is take advantage of adjustments and tax credits. Now, number 8, you're going to, this is kind of, it seems to be like the next level, Chip. So this seems to be a little bit deeper than than 5, 6, and 7. So explain what capital loss rules are.
Again, we want our clients to do a little planning and look at their portfolio, and capital losses can be used to offset capital gains as long as the securities are in a taxable account. You don't have to worry about this with IRAs, 401ks, 403bs, simples, and things like that. But if they're in a joint account or an individual account, this would be very important. You can offset the capital loss, the capital gains with a capital loss. And what you're trying to do there is, again, minimize the tax paid. Keep in mind you have to have owned the security for over a year to have it treated as a capital gain, but capital losses can be used to offset capital gains. If your capital losses, now this is important, if your capital losses exceed your capital gains during the year, you may use up to $3,000 or $1,500 for each married person filing separately of losses to offset earned income and reduce your taxable income. If you have losses met above $3,000, that can be carried forward to offset gains in future years with no expiration date. And according to what we call the wash sale rule, if you sell a security at a loss and buy back the same security within 30 days of the sale, this loss is not allowed for income tax purposes. So you have to watch that. If you do not want to be out of the market for a month, you want to consider finding similar but different investments, usually in the same asset class, to replace the security that you're going to sell. So we want to offset the losses with the gains. And what that does is reduce the tax that you may owe on those assets you've held longer than a year that would give you some capital gains exposure.
Now I think that's very interesting because making sure we've heard of tax loss harvesting. Are we in the same sort of, is that the same idea?
That's what we're talking about here. We're going to offset the losses with the gains.
Okay, beautiful. So number 9, when to buy and sell mutual funds. So it's interesting when you're talking about when to do this, because as a planner, you do this stuff strategically for tax implications, but there are also other implications too. But let's focus on the tax implications of buying and selling those mutual funds.
Okay. By purchasing a mutual fund after the annual distribution of capital gains and dividends, you can avoid being taxed on that distribution. You just have to know what the record date is. So you want to sell, and you should also consider selling the mutual funds that are expected to pay large dividends before the record date. That's the date you own the shares and the dividends are declared or capital gains distributed. I think this is very, very important because when you look at a portfolio or when you look at a mutual fund for inclusion in your portfolio, one of the things you look for is capital gains distributions. Are they kicking off a distribution that could add to your tax, or are they rolling that up and trying to increase the price per share? So if the fund kicks off a lot of capital gains, that could increase the tax that you have to pay, but it doesn't make you feel or live any better. So you got to watch that, and I think that's important. You know, the other thing we look for, and it's kind of an additional chapter here, is the turnover ratio within the mutual fund. A fund with a higher turnover ratio will create tax for you, and a lower turnover ratio will not. And turnover ratio, what they mean there is if you start the portfolio with 100 stocks, over the course of the year, how much of that portfolio did you replace? Did you replace 50% of the investments in that fund, or 60 or 70 or 80, or if it was a very low turnover ratio fund, 20 or 30%. And turnover ratio creates tax because you've got capital gains distributions and things like that. Mm-hmm. So low capital gains exposure, low turnover ratio are things we look at. And again, those are below the surface. Right. So a good advisor is going to recognize that and recognize that two equal funds, if one has a lower capital gains rate and a lower turnover ratio, it may be a better fund for you in a taxable account. Taxable account being a joint account or an individual account.
Gotcha. All right. Well, we're on the home stretch here, Chip, of the 11 strategies to save money on taxes. What is number 10?
Well, position assets in different types of an account. And initially you would think, they're talking about diversification, because diversification reduces risk. And that's been proven. But consider positioning your more tax-efficient investments in taxable accounts and the less tax-efficient investments in tax-deferred accounts like 401ks and 403bs. So if you dive a little deeper and you look at, as I said a minute ago, the turnover ratio, the capital gains exposure, if it's a good fund and they've got a great track record and they've got good managers and they handle themselves well, that fund may be more appropriate in a retirement plan where the gains and the turnover ratio are not affected because they grow tax deferred. And in the individual or joint account, put the funds that have low turnover ratio, low capital gains exposure, and things like that. So we don't want you to give up your return in the form of tax. And that's a big no-no.
Well, number 11 here, Chip, seems to have a lot of steps and a lot of consideration. So I'm just going to go ahead and launch you into the 11th one, and you explain this as deeply as you need to, because I know there's a lot of layers here. So number 11 is consider purchasing investments with tax advantages. So first off, what does that mean? And then break down how you do that.
Well, there's there's a lot of ways to look at this, but one of the things we do initially when we look at a tax efficient account, and we're talking about individual accounts and joint accounts, is we look to see what type of bonds they have in the account. Because in a taxable account, again, the individual or joint account, bonds kick off dividends. If they're corporate bonds, the dividends are taxable. So you're giving up your dividend in the form of tax. So if we substitute in some municipal bonds that have tax-free dividends, we're going to keep more of that and expose less to tax. Again, you could have a tax-free money market as part of that. We've talked about dividends, and some stocks have qualified dividends. They might be taxed at a lower rate than ordinary income. You got to look at the exposure there. We've talked about capital gains and why that's important. We look at, for some of our clients in a particular situation, we might use an annuity, and we use the new annuities that have a joint lifetime income, and the annuities grow without any tax. So if you converted some of your taxable account to an annuity, that's going to grow without any tax. And if you set it up correctly, it will essentially pensionize your income. So we're looking for ways to reduce the exposure to tax, and that could be just using a different type of bond. It could be using a different type of money market account. It could be using a different vehicle like an annuity, not for all of your investments, but for perhaps just a small amount to not get caught up in the capital gains tax as you go forward with that. So we want to be as proactive as possible so as to limit the tax the client pays, because we have to be tax sensitive. And again, I've said it earlier in our broadcast today, you want to keep more of your income in your pocket and pay as little as possible to the government in the form of taxes. And you have to be proactive, and you got to do some planning to make that happen.
Well, Chip, thank you very much for diving into these 11 strategies to save money on taxes. If you wouldn't mind, would you mind giving us a quick synopsis of what those 11 strategies are, and then we'll be done for today.
Sure, let's go through it. Number one, participate in your employer-sponsored plan. If your employer has a plan, get into it. Start with the minimum maximum, the minimum you need to put in to get the maximum match. That's tax deferred, and it'll really pay dividends over a long period of time. So if you're young, get in, stay in, reinvest along the way. As I said earlier today, begin with the end in mind. A little bit of money over a long period of time, you get an explosion of value. Number two is contribute to a traditional IRA. And I think that's very important. If you don't have a 401k, 403b, or a simple IRA at the company you work for, put money in your own IRA. You control it. You pick the risk. And you can put in up to age 50, $5,500 a year. If you're over age 50, you can put in $6,500. And that's a good thing. Number three is contribute to a flexible spending account. If you're going to have healthcare expenses and dependent care expenses, this is a great way to do it rather than paying them with after-tax dollars. So again, it takes some planning because you don't want to over-contribute because you may forfeit those dollars if you don't use them at the end of the year. But if you know how much your child's braces are going to cost, or you know what you pay for daycare and things like that, do a little planning, figure that out. It's cheaper dollars. Number four, consider the tax implications before you retire. We want our clients to go into retirement in the best possible shape they could be in. And we have to take a snapshot of where they are today and where they want to be in retirement. And we want to make sure that anything we do is a positive for them rather than a negative. Negative would be paying more taxes. And we have to be proactive here. So when you retire is a big question. Many times the end of the year is not the best time to retire. It's the end of the year, but it may not have to be the end of your career. You may want to put that off a little bit for logical reasons. Number five, itemize your deductions. If you have a bunch of deductions, starting with mortgage interest and heading down the line, if you itemize, you can save money on your taxes. And any tax professional can help you do that and really bring those to the surface, the deductions that you have available to you. Number six was consolidate deductible expenses. You don't have to itemize every year. It could be every other year. So again, you got to be proactive. You have to do a little planning, and I think that makes sense. Number seven is take advantage of adjustments and tax credits. If they're out there, take advantage of those to lower your taxable income. Again, more money in your pocket. Number 8, use the capital loss rules to your advantage. Again, capital losses can be used to offset capital gains. A little pre-planning at the end of the year. This is a November, early December kind of play we're talking about here. And you want to stay up on that so that you're not paying a tax you didn't have to pay by being a little bit smarter. Number 9 is when to buy and sell mutual funds. Most of our clients have mutual funds. I would tell you, and we could spend a whole day on this topic, with mutual funds, there's the good, the bad, and the ugly. But when you buy and sell your mutual funds is very, very important so that you don't incur extra tax. We want to buy after the annual distribution of capital gains and dividends, and many times we want to sell before that happens. This applies only to individual and joint accounts, not accounts that are in IRAs or 401ks and 403bs. Number 10, position assets in different types of accounts. We want the non-qualified assets, the individual or joint account, to be as tax efficient as possible. And there's different steps you can take to maximize that. And number 11, consider purchasing investments with tax advantages. Well, the IRA is a tax advantage. You get a deduction for doing that. Your 401k or your 403b would fall into there. So you want to use those vehicles that give you a reduction off your taxable income to build your future. Because the IRS puts these out there, and it's really up to us to take maximum use of those to pay less taxes and keep more of what you earn in your pocket. Does that make sense, Matt?
Absolutely. And thank you for your thought leadership and your wisdom today, Chip.
Great. It's great to be here.
All right. And we will see you all soon on the next episode.
Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Stratos Wealth Partners, a registered investment advisor. Stratos Wealth Partners and Retirement Income Analysts LLC are separate entities from LPL Financial. Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.